Hi, my name is Robert Mittendorf. I'm a venture capitalist in Silicon Valley with a firm that has about $10 billion under management. We invest across the spectrum from seed stage to venture to growth to buyout and across sectors from consumer to enterprise software to growth opportunities in any industry and to healthcare across multiple geographies, including the United States, Israel, and India. I also am a practicing emergency physician during the COVID-19 pandemic. Many technologies and tech-enabled services have dual-use applications. In fact, many of our most important technologic advances have been both game changers in the military and civilian worlds. From global positioning satellites to medical robots to the HoloLens and to cybersecurity technologies, dual-use applications have a history of leading to major impacts for military, intelligence, and civilian customers alike. Dual-use technologies are particularly promising as investments if they are compelling because they satisfy the tenet of providing value in multiple diverse applications. In fact, some of the most interesting investment returns have been a result of technologies used in the military, intelligence, and civilian spheres. Early revenue from military contracts or use cases with similar technology that can be used in civilian applications can be a powerful signal to the investor that product market fit exists. It is important, however, that the company also focus on civilian applications in civilian markets where such value can be demonstrated clearly. We value the revenue from military and civilian sources differently, and the ultimate value of a company is usually a result of its civilian applications and revenue, even though military revenue can be a powerful validator of product market fit for the technology. SBI program grants and loans are great ways to finance the early development of technologies to a proof of concept stage. Dual-use technology development, as is often seen in the SBIR program, can be a very attractive investment opportunity for venture capitalists like me. A key part of this is delivering a compelling argument for why the technology is in fact dual use. It's important when considering a dual-use technology to assess the true market potential of the applications for that technology outside of the military. I would focus on three tenets when developing technology for dual use. Number one, the dual-use value proposition. Is there a compelling value proposition for the military and civilian community within the same product or service offering? Two, early dual-use proof of value. Are there early product development milestones that demonstrate this value to both military and civilian customers? And three, revenue-generating project. Are there existing budgets within military sponsors and civilian customers that can be used to demonstrate by the company near-term revenue traction? I would also focus on civilian market potential that exceeds $500 million a year, that is 500 million a year, when sized using appropriate metrics. If a technology application is sufficient to satisfy all three of these tenets, the dual-use value proposition, the early dual-use proof of value, and is revenue generating with a civilian total addressable market of 500 million or more annually, you probably have something of interest to a venture investor. COVID-19 is transforming the state of business at both the macroeconomic and microeconomic levels. We have had economic effects of prior outbreaks, but this pandemic will have a broader and deeper effect on all human activity. Specifically today, companies need to remain nimble and preserve cash. In fact, we recommend every venture-backed startup to develop a 2020 and 2021 COVID-19 operating plan. Startups need to think about the following three areas of their COVID-19 operating plan. One, revenue. Think about how your ability to generate revenue has changed as a result of quarantine, travel restrictions, customer budgetary uncertainty, and other drivers. Consider the cancellation of key conferences to lead generation and deal closure. Also consider new opportunities to create value in the COVID-19 environment, which may generate new revenue streams. Build a 2-year top-line plan based on your findings. 2. Cost of revenue. Consider how your cost of goods and services may reflect the COVID operating environment. If you have human labor in your cost of goods, you may need to retain this personnel even in a lower revenue scenario, which will reduce your gross margin. Consider that. Also consider scale cost modifications and other effects on your supply chain, which are typically adverse, and the availability of the needed inputs for your products and services. 3. Operating expenses. Evaluate where you are spending your OPEX and consider ways to trim or eliminate expenses and headcount in the next 2 years in a strategic way. Consider what can be cut given your revised revenue and cost plan without sacrificing value. Once you have done the above exercise, you can move on to understanding how that will affect the capital required to weather this storm. Evaluate all options to shore up the balance sheet, including drawing down debt lines, pursuing SBIR and SBA grants and loans, and other programs. And finally, pursue venture investment as is feasible in your current environment. Your COVID plan should incorporate all of these areas and will place you on the most solid footing to be prepared and ready for the next 18 to 24 months. The venture window is not and will not close because of COVID-19. A significant amount of private capital has been raised and is available for promising companies, especially for dual-use technologies. That said, venture and private equity funds will support and circle the wagons for their existing investments first, ensuring that they are properly capitalized. New deals will happen and capital will be deployed into new companies this year, but the bar will be higher for the execution of these deals. Diligence will be challenged due to social distancing and travel bans, and pricing will reflect the market downturn. The key will be to present investors with compelling, timeless value propositions with a very well thought out and conservative investment plan and appropriate equity pricing.